Was beginning to wonder if that was actually going to come on or not. Welcome back to another live show, guys. Hope you guys are having an awesome week. Josh and I are here to answer your mortgage and real estate questions to help you become the educated home buyer. So since last Wednesday, we've had a couple of different reports come out with regards to data. We got pending home sales coming out, more or less flat, but better than expected. We have news from Case Shiller, from FHFA, which we're going to take a look at when we look at the slides here in just a minute. Last Friday, we got PCE data that came in a little bit higher than expected. Today, we got JOLTS data, so job openings. And Friday, well, actually tomorrow and Friday, we're going to be looking at jobs. So we get ADP tomorrow, and then on Friday, we get unemployment numbers, the official unemployment number. So Josh, a lot to unpack. So with that said, how are you this evening?
Oh, it's good times, Jeb. It feels like Groundhog's Day. We keep getting conflicting information, good report, bad report, good report, and the market goes one direction, then turns around and goes back the other direction. So Groundhog Day over and over again.
Yeah, absolutely. And before we dive into the slides tonight, guys, I want to say thank you. Last Wednesday, we were on here trying to hit 1,000 subs, and we did it with your guys, with the help on the Educated Home Buyer Podcast YouTube channel. So we really appreciate the support, you guys showing up, liking, subscribing, doing all of that. We're at 1,041 tonight. So we've done really, really well, better than we had expected over the last couple of days and growing that channel. So, couldn't have been done without you guys. So that we are thankful. And if you haven't listened to the podcast, go check it out. YouTube channel. It's on Spotify. It's on, Apple, any platform you listen to. It's a deep dive into real estate specific topics. The last couple have been, talking about the idea, if you're not going to buy a house, how do you get to the same financial position as a homeowner with 44 times greater net worth than a renter if you're not going to own that home? So that was last week's episode. And today we recorded an episode about interest rates, the direction of interest rates, why things haven't really progressed the way that we thought they would, what we're expecting, all of that. So that's going to post next Tuesday. So if you haven't done so, check that out. So Josh, without further ado, because we have an hour, let's take a look at some charts here. I'm going to go back the other direction. So we do this every week. You guys have asked for a link to the slide. So if you're on audio only listening to the podcast, it is in the description of whatever platform you're listening on. You'll be able to go and look at those slides. If you're here on YouTube, really easy. You can see it on the screen, or if you want to see the slides, download them, do any of that, you can go to the link there that we mentioned. So here we go. As we do every week, we start with inventory. So inventory increased, 2.1% from last week. So we're sitting at 433,000 homes. It's headed in the right direction. Not by, any historic metric, if you will, like it's not moving fast, but it is moving. So that's positive. Orange County here where I'm located, 2129. So we actually have less homes this week than we did last week. Huntington Beach sitting somewhere about the same. So nothing really to report there. Again, we like to look at this chart, historical metric showing you inventory going back, as far as 2016, just shows you, a little bit of historical context of where we sit versus more normal times. This chart, new listings. So this is the reason you're not seeing inventory grow. It's because there's a lack of new listings coming to the market. So you might say, well, how is inventory growing? Well, it's because there's less buyer demand out there in the market. Part of that has to do with mortgage rates. Part of it has to do with housing affordability. Part of it has to do with, seasonality. Kids are now getting out of school. So that's not really reporting quite yet, but that's when you're going to start to see less activity in the market and probably listings build for a couple of weeks. But until you see new listings tick up and stay up, you're not going to see inventory grow by any meaningful numbers. And this is a little bit of change going back week over week. I love this stuff because it kind of just shows you where we were last week. So, we went from 420. Actually, that's the same chart as last week. So that is not the right one. I didn't put the right one in there. But anyhow, basically, our numbers are growing. We're sitting at 433 homes today versus 424. Last year, so we were sitting somewhere around 338,000, 340,000. I didn't put the right number in there, but the peak bottom for 2022 was 240. Peak for 2023, which is still accurate, was 472. That's where we started the year. And active listings, for context, back in 2015 was sitting over 1 million homes, 1,100, or actually 1.1 million rather, not 1,100. Active listings versus homes under contract. I'm not going to dive into this because we do it every single week, but I am going to click through them here just so you guys can check them out. Just shows you, again, market is still moving, less pending sales right now on the market, 4.8% fewer new contracts this week, which equates to 67,191. That's 14% fewer than last year. Again, we talk about that, less inventory to choose from, but also less demand in the market. That presents a problem when trying to go into escrow. Median home price, again, rising to 425, or median home price sitting at 450, median list price at 425.
That one, Jeb, always throws me off. I look at it, I'm like, why are new listings? Because it's consistent. It's consistent going back to 2018.
Going back and forth. Yeah.
Why are the homes that are selling? Is that because so the list price comes on at 425, but they end up the typical home selling for 25,000 more? Like, if you want to tell me that during 2020 and 21, I'd say that's a pretty good explanation. But it's interesting that we're still seeing that gap, that the median price of coming on. Those should, to me, be fairly similar.
No, yeah, and unless people, I don't really have
because
an answer.
The lower end is more active, so I would expect, if anything, the closed would get pulled down by more things selling at the lower, more affordable price points versus higher. So to me, like, I'm not saying it's right, but the only obvious conclusion you could make is that things are selling for above list price at the median level.
No, exactly. Yeah. And there is some context because it goes with these slides. I don't usually put it on the screen just for time purposes, but maybe going forward, we could take Altos research data, the way they explain it, and put it up there to help people understand it too. So again, median price of homes in contract, 384, 1.3% below last year. And then price reductions. Price reductions are ticking up a little bit, sitting at 30.2%. Last month, I think we were at like 29.6%. So a little, more buyers, or more sellers rather, are having to reduce prices for one reason or another, right? Homes are sitting on the market a little bit longer now. So Josh, we talked about this a little bit. Worst year for 10-year treasury bonds since 1788. I want to know who was keeping track of this in 1788.
Yeah, like, can you imagine in 1788, there's someone with a ledger that says, hey, Jeb owns a bond and he bought it at this price. Like, that's mind-boggling that they have the records. But 1788, what in the world are we talking about? 240 years of data there. But what I like to look at is that shows you, and this is not actually that interest rates shot up over the last year. It's just saying if you had bought a bond, year over year performance in the value of that bond is the worst since 1788. But looking right after 1788, I don't know if each bar represents 5 years, 1 year, but over the next 5 years, bonds kind of went through the roof in terms of values going up. So if you had bought in 1788, there was a great opportunity to profit as bond prices went up and yields went down over the next few years. I think we're likely to see that going forward. But those were the two things that were amazing to me. We knew the last year was bad, but everyone throws out, hey, the worst in 40 years. Well, it's actually the worst in 240 years.
Yeah, Josh is just trying to open up a fund to take in money so that he can bet the inverse of the bond market and hopefully reap big rewards.
Yeah.
So a long view here, looking at rates, GDP, inflation, and stocks. So what do you make of this?
It's a cool chart. Probably the big thing you want to see there is that dashed line to the right is the 40-year bull market in bonds. And a lot of people are going to tell you that that is over. We broke that 40-year trend, and that's indisputable. The 40-year downtrend has been broken. But to me, it was largely due to the Fed actions. You know, rates would not have gone as low as quickly as they had the Fed not intervened in the way that they did, and they wouldn't have shot up as high as they have now. I think that would still be intact. And I think the underlying demographics and things that are going to cause that will come back into play. Kind of, you know, a preview, Jeb, of next Tuesday's show is that it's just taking longer for things to normalize. And I don't think what I've come to learn over the last 18, 24 months is I don't know when it's going to normalize. Is it 1 year? Is it 3 years? Is it 5 years? But the underlying fundamentals that I trust, I believe will lead to lower interest rates over the long haul.
Good stuff.
This fun one here, Jeb, if you look at those red dashed lines, not the two in the channel, but that shows it's the same thing, showing that downtrend in interest rates. But what we're looking at the bottom there, the very bottom red dashed line shows when bonds were overbought and likely then to recover. And it's been a very predictable marker of bonds doing much better, of yields decreasing going forward. And when we look at that, this is the most overbought or oversold that bonds have been historically. And I don't see this chart goes back, I think, what, to the mid 1950s, 40s, something like that.
Yeah, I can't tell there. I think it says 1994 on the left, but I can't.
Okay, so 94. We're going back 30 years, closing in there on 30 years. And we've had 1, 2, 3, 4, 5, 6 major buy signals. This is far and away the biggest buy signal. And going back to that last chart, the last time bonds had performed this poorly on a year-over-year basis, you saw a monster recovery. So again, what does that mean? We're conditioned to think, well, last time that meant treasuries went down to a 0.9 yield at the low, 1.3, and stayed there for a while. That was artificial in terms of government buying. So I don't know that that's possible, but we don't need that kind of a recovery. If you go from, what did we close, Jeb, today at 3.64 on the 10-year? If you go from 3.64 to 2.2, which is very doable, you buy bonds right now, especially with a 2x leverage on it, you're going to make a lot of money, Jeb. I'm going to get some investors. We're going to make some money. We're going to buy houses cash. We're not worrying about mortgages by the time we're done.
And this is looking at the treasury short. So yeah.
So net short interest in 2, 5, and 10-year treasuries. So going back there to 2000, in the last 23 years, it's almost double the short interest. And the reason why that's important is, let's say the fundamentals start leading bonds back in the direction of normalizing. You have all that short interest that will get squeezed out. So what happens to a short when they're getting squeezed? They have to become buyers. They don't want to, but they have to. So you'll see rallies that are bigger than the underlying fundamentals would suggest. So again, just going through these charts, Jeb, I'm hoping I'm making the case. If you guys want in, we're going to put together a little fund and we're going to get rich.
Too good. He is not a financial advisor. I'm not sure what kind of disclaimer I've got to say here, but
don't listen to this guy. Just do as he says and just reap the
Yeah.
rewards.
Yeah, there you go. So what are we looking at on this one? The TLT.
So the TLT is basically a 20 plus year treasury bond ETF. So it shows you, and this is it set up there against the 10-year treasury. So, or actually, is that Fed funds? I believe it's Fed funds that they're showing. No, it is the 10-year treasury. So as the 10-year treasury goes up, that bond fund performs poorly. But what they're showing here is such a decline would imply an increase in bond prices of approximately 50%. So again, going from where we are at 3.6 to somewhere 2.25, 2.3. So it tells us a couple things. There's a profit opportunity here for investors in bonds after the bloodbath of last year. But on top of that, if we got a treasury 2.25, 2.3, and we go from a 3% spread between treasuries and mortgages to say a 2.5, you are back into a 4.5 to 5.5% mortgage rate fairly easily.
Yeah, and put this chart in here for census data. So this information just came out. Just some interesting stuff in here. One of those things that not going to dig into a lot, but just shows you, I mean, this was 2020. So now obviously it's 2023, right? So 3 years past this. And since then you've had, vacancy rates continue to decline. Rental vacancy rates continue to decline. Home ownership rate. I don't know if the home ownership rate is above 63% at this point, Josh. But we've had a lot of buying over the last 3 years since this census data numbers came out. It just, again, household formation, everything happening, a lack of supply out there tells you that there's a really good chance that home prices aren't going anywhere because there's still demand out there in the market from where you can see numbers are versus, historical context. And there's Josh, phone ringing. Jolt's numbers again.
The phone that's on do not disturb. So apparently
Jolt,
someone in my favorites list decided to call.
There we go. He's only got one other person. He's only got one person.
I got two.
List.
I got two favorites.
So is your wife?
It's my wife and my dog.
There you go. So Jolt's data here. So this is a chart. This is essentially what came out today, saying we have just over 10 million jobs. I found this chart interesting. Just shows you, the number of employees that quit versus the number of employees that were laid off versus the number of people that were hired, and then also the number of job openings. So, it's crazy to me. And there's a question here that's gonna come up that we're gonna talk about. Asking about the idea of Goldman Sachs and JP Morgan, wanting or demanding that workers come back to the office. What does that mean? Well, when there's 10 million open jobs, I feel like, the employee has the decision, the opportunity to make that decision, not the employer, because if they don't like it, they just go find another job somewhere else. Now, maybe not at the same rate, but we'll talk about it. And Josh, I know we talked about FHFA. Again, we talk about these every week, but 3.6% year over year FHFA, and then 0.6% from Case-Shiller.
Yeah, in the Case-Shiller's paired sales, FHFA excludes jumbo loans, cash buyers. So Case-Shiller's probably a better measure there. They both have their biases. We talk about why median's not the greatest number, the NAR's median number. None of them are great. All taken together kind of gives you a view. So we're muddling through with some level of appreciation, not seeing a downturn, but some level of appreciation. And then Jeb's going to pull out the list of the cities that are not so lucky.
Well, yeah, but I even look at this and I go, okay, yeah, you're not, it sucks, right? If you lived in Boise, in theory, based on this, you're down 11%. That market probably appreciated 50, 55%, whereas most markets appreciated 35 to 40. So yeah, they gave some of it back, but I mean, you'd almost be crazy to think that that wasn't going to happen just based on how nuts that market was. But even then, you do have some markets. These are the largest changes from the peak, based on, I forget what actual model they're using here, core-based statistical area. I'm not sure exactly what that is, but came from calculated risk in a report that they sent out this afternoon. But again, 5.5% here in California. You don't have a lot of California cities on there. Santa Cruz, Fairfield,
Jeb, I look at two numbers there: Spokane Valley, Washington, Coeur d'Alene, Idaho. I went to school at Eastern Washington University, very familiar with Spokane market. Cheney's just 15 minutes outside of town. Coeur d'Alene, probably the best example that I have. There's a cool newish condo, 4-story on the river, just outside, just off the lake, Lake Coeur d'Alene. And in the downturn, like 80% of them went into foreclosure. You could get them for less than $200,000. A year ago, I was up there and I'm just looking at real estate while I'm there at my grandma's house, pull up $1.1 million, $1.2 million for condos that, 12 years earlier, 10 years earlier, you could easily pick up for $200,000, $300,000. And you're looking like, that's just an astounding number. And there's no fundamentals. There's no economy there in the inland Northwest that supports that volume of high home prices. Lots of Californians leaving the area. And if you look at that list, Jeb, lots of those are Lake Havasu. There's nothing. There's no industry. There's no jobs in Havasu. What are there? Lots of Californians that retire, sell their $1 million house and go there and buy a $500,000 house. Soon enough, that becomes a $700,000 or $800,000 house. So if you look at a lot of those markets, lots of people hating and cursing California.
And there's somebody, Patrick's in here saying there's a lot of California on there when I said there wasn't. I think there's 6 or 7 in this list. But what I mean by that is most, like, you take, for example, Merced, one of the most expensive markets in California, I believe, it's down 5.5%. Napa, also an expensive market. San Francisco, a super expensive market. Like, these are, again, most buyers aren't looking to buy in the majority of these markets, at least the people watching this show. So, the Orange counties, the Riversides, the San Bernardinos, the Bakersfield, those markets, yeah, maybe you saw a little bit of a decline, but nothing significant. And those are the people that need it. Those are the people that really could benefit from a decline in prices, right? The markets that we really need to decline aren't the ones declining. It's the ones that were so overbought that now it's taking a breather, a lot like we were talking about earlier with the with treasuries. So nevertheless,
Jeb, I went back and I re-looked at your list there. So
yep.
it is all, except for the one in Louisiana, it's all California or places that Californians went and drove prices to the moon. Like literally, other than the one in Louisiana, it is all markets that Californians went and drove prices way higher than they should have gone.
Yeah. And again, it's at the end of the day, doesn't matter. But I just thought it was interesting, data, because everybody wants to talk about the decline. So, hey, let's talk about the declines and what it really means. And are there people affected? Absolutely. But only if they have to sell their house. So the majority of people out there are still holding on to that 3% interest rate, which I'm sure we're going to talk about tonight. So let's start at the top, Josh. Let's see. Platinum Black. Have you had any offers accepted recently? Sounds like it's been tough sledding lately. So yeah, it's definitely a slower market. Had an offer accepted, 2 weeks ago. Some buyers that we've been working with for a couple of months now. We put in 20, 25 offers. Finally got an offer accepted. I explained it in a video that I did today that's actually going up on, believe it or not, I have a third YouTube channel that is an Orange County, Huntington Beach related channel. So more specific to our market or my market versus national data. But, where they made progress is they were approved to about 1.2. And a lot of the homes they were looking at, they were kind of, looking at 1.1, $1.05 million. And because the price point they were looking at, a lot of those homes were selling for 1.150, 1.2. So they were pushing their budget every time, and we couldn't find success. We couldn't bid as high as we needed to in order to, compete. So we went under $1 million, found a property that needs some work, and they were able to make progress. So that said, finally able to get them into escrow. Have a couple listings coming to the market here soon too. So we'll talk about those as they come up. But on the buyer side, that was the one that's been killing me over the last couple of months. We're finally able to make it happen.
Jeb, I will say from my end, almost all of my buyers are getting clubbed in the face right now. And this is, I mean this as as sort of solace to those of you out there buying. But I did my vetted VA live last night, and we have a lot of veterans pop up on there saying, hey, it's super hard to get a VA offer accepted because of it being zero down. I got a client right now in the 700,000 price range, putting $400,000 down and getting outbid left and right, cash offers coming over the top. So it's tough. It is tough all around. That being said, I have 3 clients that were wanting to lock our rate this week that have got things under contract. So when you look at it, is it all terrible? No, there are people out there having success, but volume is down and successful offers are down. And in the competitive price ranges, all of my buyers are having a hard time.
All right, there you go. I'll post that channel here in a minute. I actually don't know the name of it. That's the best part. I didn't know the link, so I had to look it up. So I'll post it in just a minute. Let's see. We've got let's just go here. Davey says, question mainly for Josh. Josh, I know you have property in Palm Springs area. I do as well. What month would you say is the best month to list for rent and or for sale?
I would defer to a professional realtor in the area. The property we were talking about last week that I would like to buy is in Rancho Mirage. It's directly next door to my property there. Came on the market a week ago and is already under contract. And I was telling Jeb, I want to reach out to the agent there because he knows that area far better than I will. But to my understanding, what you want to do is come on the market in the early part of the rental season, which plenty of people want to go out to the Palm Springs area. And Palm Springs is a little different than, say, Rancho Mirage, Palm Desert, which is more snowbirds, versus a lot of people from Los Angeles love going out to Palm Springs. It's a hipper, younger, cooler area, although the weather in the Gulf is the same. But if you're relying on either your tenants, renters, or your buyers being snowbirds, they don't really arrive in mass until towards the end of January. When we first bought out there, I was kind of surprised by that. I'm like, I love the fall in the desert. That's my favorite time of the year. And say, well, cool. Fall hasn't been awful enough for Canadians to want to spend money to fly all the way to Palm Springs. So they start arriving heavily in mid to late January. February, March, April are your big time. So I would want to be on the market at the early part of that window to get as much exposure to those folks, because they're the ones that are most likely to buy. In terms of being on as a rental, most of those folks have made their plans 2, 3, 4, 5 months in advance. We start seeing inquiries for ours. We do monthly rentals. It's all we're allowed to do in Rancho Mirage now. And we will put it on for the 2 months of the season that we're not using. We make it available, and we start getting inquiries late spring, early summer, because people have just enjoyed their trip to the desert and they want to book for the following year.
All right. Cindy says, how do presidential election years usually impact the housing market? So possibly volatility in things, but I don't think that there's going to be a big change in the housing market just because of a presidential election year, especially this year, because really it just comes down to supply, demand, and really where rates are. But what more so what you have is people or politicians pitching home ownership and these political ideas around home ownership in order to buy, quote unquote, buy votes more so than anything else. But as far as a direct impact on prices or anything like that, I'm not aware of one. Josh, anything?
Again, I was on that vetted VA Live, and a realtor from the state of Washington, who I trust a lot, kind of has talked about election years, the market slowing down. It's not something that I've noticed in 27 years. So it gives me six and a half election cycles. It's not something that strikes my memory as the market really slowing down during those timelines.
There you go. VAR watch. BlackRock has mandated all employees to return to the office 4 days a week from September. JP Morgan mandated directors back to the office 5 days a week. Goldman the same. Do you see an impact to the housing as a result, a reverse from WFH, work from home? So I don't personally. I mean, everybody said that was going to be one of the factors that drove down housing prices 6 months ago, 8 months ago, when everybody had to go back to the office. And what we found is most employers are basically, the ones that were saying that you had to do it are kind of backing off of it a little bit because, again, employees were leaving and finding other opportunities. And I look at the market going, there's a lot of open jobs out there. there's probably an employer that will allow you to continue doing what you're doing and, and not have to go into the office. Therefore, I think there are people out there that would make a change versus going back into the office 4 to 5 days a week and what have you. So hard to say, honestly. Could it affect some? Absolutely. Is it going to affect most? I say no, just because I think employers rather, are figuring out a way to, have a more cohesive environment with people working from home. Although, it's not ideal. I think, that's kind of the stage we're in. Josh, what are your thoughts?
I go back to that JOLTS chart that you posted there. So the worry from the Fed is with all the job openings and the competition over employees that it's going to drive wages up. We've shown the chart every month for the last few months and don't really see the wages increasing. They're moderating kind of to the historical norms, 4 to 5% annual wage increases. But this tells me there are other things that employees can push back on. If you have 2 or 3 jobs to choose from, the one says, hey, you can work from home 4 days a week and come into the office once for a meeting, and the other one says, no, we're making everyone be in the office 5 days a week. It's going to be a hard sell. I don't think, especially for seasoned employees, older employees, getting them back in the office, they don't have much reason to be in the office. They know how to do their job. The people that benefit are younger workers, where they can learn the culture, they can learn the job, they can learn from some of those older workers who've been on the job for a while. So are employers going to push for that to happen? Yes. Are employees going to push back against it? Yes. Is it going to be different than it was in the middle of the pandemic? Yes. Is it ever going to go back to the way it was before? No. And that will put pressure on the commercial real estate market one way or another.
All right. When rates come down, triggering more sellers to enter the market, will it tilt the trend in favor of buyers, Josh?
We talk about this every week. We don't think so, because the balance of supply and demand will remain similar. It will bring more buyers into the market, first-time buyers, because affordability increases, and the majority of those sellers who are putting more homes on the market are not selling to go off and rent in a mobile home park somewhere. They're going to be buyers as well. So although it would bode well for increased volume of sales for realtors and mortgage people, I don't see how it really resolves the issue for buyers.
All right. I agree 100%. Red Apple Kim says, does homeownership look grim in 24-24? So in 400,
I hope I'm not around to see it.
In 401 years, Josh, what does homeownership look like?
Kim's taking the long view on this one.
Yeah,
I don't know that I have
when
that
we said
level of
own a
patience.
home for a long duration, a period of time, she's thinking 400 years. And I think you're safe. I think you're probably really safe if you own your home for 400 years.
I would hope that 400 years from now, all problems have been resolved, that everyone has everything that they need, including housing.
No, but let's back up and say 2024. So a year from now, do you think homeownership looks similar to what we're seeing right now, or do you think it looks different?
More of the same for buyers and sellers, with slightly better affordability due to lower interest rates, but I don't see a significant change for anyone's benefit.
All right, there you go. I was, trying to find some questions here, so let me dive in.
Let's look at this one, Jeb. It's actually easy. Don't really want to go super deep on interest rates, and here's the reason why. So the question from Platinum Black says, what kind of rates are highly qualified buyers able to get these days? 800 FICO, lots of income, no debt, 20% down, ready to go. Rates have absolutely popped up. We saw some nice recovery the last couple of days. We're going to see tomorrow or the next day if we get some decent news on that jobs report. So meaning not a hot, strong jobs report. Hopefully unemployment ticking up, even at 3.6, 3.7. That's still a spectacularly low employment figure, but it would be trending in the right direction. Hopefully keep the Fed out of play in June. If that's the case, we'll be right back in the range where we were at, which should get us back down into the mid sixes. But the big question here is, at 20% down, even with an 800 credit score, with all these LLPAs in play, rates are not great. The jumbo lenders, we can get you mid sixes, and you're looking very high sixes if you're looking at a standard conventional loan. So FHA terms can be had much, much better. If you're willing to pay a little bit more than a point, you can get that down with a 5 handle on it versus high 6s. But at 20% down, no one wants to hear that. I don't think, Jeb, we have fully seen the impact of the LLPAs, because I can look at the bond market, and historically my brain tells me when I go and price out a loan, this is what it's going to look like. Most of my clients, when I price it out, I look and I go, what in God's name happened here? And how did that interest rate get that high? Mm-hmm. And you look, it's because the LLPAs are much more than what they were. As a result, we're seeing a lot more interest in FHA loans. And for me personally, I've always really enjoyed working with veterans and with the VA loan program. And we avoid and sidestep all of that. So when I'm looking at who am I creating content for, who am I trying to get in front of and have conversations with, I'd much rather talk to a veteran right now, just because that program sets up much better. I know it doesn't help most of the people watching today. You're not going to go join the Army and enlist for 4 years.
Here's the deal. I don't discriminate. So if you need a real estate agent locally here to Orange County, veteran or not, would love the opportunity to help you. If you're a veteran and you need a mortgage lender, Josh is a great resource. Everybody else, he just said he doesn't even care about you. That's rude. In all reality, if you need a mortgage broker, California, kind of the western part of the United States, reach out to Josh. I'll put a link on the bottom of the screen here in a minute. Orange County Real Estate would love the opportunity to help. This is that part in the show. We're about halfway in. I'm going to ask a favor. If you're watching now, you haven't done so already, hit that thumbs up. Subscribe to the channel. If you just watch our videos and, don't take any action, that helps the YouTube algorithm. Helps me accomplish my goal. I'm trying to hit 100,000 subs, primarily for my kids. They love the idea of the whole play button, because everybody they follow has millions of subs and they want a play button. So I said, if we get one, you can have it. So let's help them get what they want.
They can't figure out why Dad's such a slacker. They get 100,000 measly subscribers.
Like, Dad, how many people were on your live tonight? And I'm like, I don't know. The max is like 200. And they're like, that's not very many at all. The people I watch, they have 50,000. I'm like, well, that's great, kids. Thanks. You just deflated me. But no, in all reality, I'm grateful for you guys. Go over the other YouTube channel too, the Educated Homebuyer Podcast, and check that out as well if you haven't done so. So this is an easy one. S. Smith says, do realtors charge for staging your home? And can you stage the home after your home has been on the market for a few months? The answer is yes and yes, but not always yes and yes. So yes, you can absolutely stage it after it's been on the market for a couple of months. But what I would do personally, put it on hold, get new photos taken, upload the new photos, bring it back to the market. And probably when I bring it back to the market, also do some sort of price improvement to get some attention to the property and kind of all coincide. Your other option is to pull it off the market here locally. Has to be off the market 90 days in order to re-trigger the days on market. If you're willing to do that, that's a good time to stage it, bring it back new, and then, nobody really pays attention. Well, people do pay attention, but it's a good time to refresh the listing. Will your agent pay for it? In some cases, the answer is yes. I will on certain properties, but it's a conversation I'm having normally in the listing presentation. If the house needs to be staged, we talk about what that looks like, because that all factors into commissions and all of that good stuff. So not going to dive into that here, but yeah, the easy answer is yes, it can be, but just have a conversation with your agent and they can guide you through that process. Another easy one, Josh. Anya saying the 1% down mortgage with no PMI insurance payment, does that make the borrower not protected? So I guess there's a belief out there that the mortgage insurance protects the borrower. It does not. It protects the lender against you as the buyer or borrower defaulting on that loan. It's never protected the borrower. So in this case, I don't want to dive into the loan aspect of that, but Josh, anything I'm missing on that?
No, you're 100% correct. And both of those programs, Rocket offers it, United Wholesale offers it. They do have mortgage insurance. They're both underwritten to either Home Ready or Home Possible guidelines. So it's reduced mortgage insurance, and reduced mortgage insurance, limited to LLPAs. Either one of those lenders is coming up with 2% of your 3% down payment. So it's an awesome program if you can qualify. For those of you in California, you kind of chuckle when you see it. But if you're in an area where you can buy with 80% of the area median income, it is an amazing, awesome, wonderful program. So if you're interested in it, reach out. But they do have mortgage insurance on those loans, and if it didn't, it would mean that the lender is the one that's not protected.
Okay, Josh, I wasn't paying attention because I was reading comments, but it says, can you touch on Rocket Mortgage 1% down payment offer? And also they will pay the mortgage insurance. So I know you just gave a little bit of context, but anything else to add there?
So essentially, if you qualify and meet the guidelines for Home Possible or Home Ready, so 80% or less of the area median income. When UWM first came out with it, they rolled it out at 50%. So it was like not just eligible for Home Possible or Home Ready, but like super eligible because you have a minuscule qualifying income. And the reason why they did that is they literally are paying 2% of your 3% down payment. So say, hey, if you can only make 50% of the area median income, it's really going to limit the loan size, limits their exposure and their cost. So it does help entry level, lower income borrowers get in the home market. Good PR for them, good all the way around. Well, Rocket came out and said, hold my beer, we're going to do it at 80%. So they were forced to match. This is now the second person saying, hey, and they'll pay the mortgage insurance. Let me dig into it because I didn't see that anywhere. Definitely didn't see it in UWM's. Rocket may have one-upped them again with that. But what I would say, you can't get something for nothing. So they're having to insure it. Yeah, they're having to insure it, and they're already eating 2%. So I doubt they're going to eat it more than that unless both of these companies are public companies. They are sitting on monstrous amounts of cash from the boom years, and they are wielding that power over every other lender in the country. And when I say that, I can take a loan to either one of those lenders, or I should say I can take one to UWM. UWM won't let you work with both of them, but a broker can go to one or the other of those companies and place your loan. You can only go through a broker with UWM. Rocket, you can go directly to them or through a broker. Through a broker, you're going to get better terms. I wouldn't be surprised if them covering the mortgage insurance is something through their retail, and their retail has much worse terms than what you'll be able to get through a broker. But is it a good program? Yeah, it's just a very, very narrow box. If you fit in it, just be thankful because it is a good program. It's your standard Home Possible, Home Ready, but with someone else covering 2/3 of your down payment.
There you go. Orange Pulp has a good question. Says, thoughts on income to home price ratio, putting a possible upper limit on house prices, no matter how limited supply is. Yes, I mean there's some truth to that. At some point, people max out, and demand goes down. We're already seeing it, but what I've figured out to some degree is that there's always buyers. There's always people with money. There's always people with cash. There's always people looking to do something, maybe not at the same rates. And I say rate like the same ratio as we've seen in the past, but there's still activity out there in the market. So rates moving higher, housing affordability having a play will definitely have an impact. But the question is, without supply coming to the market in any reasonable way, it will take years and years for that to really have a significant impact, at least in my opinion. You need more than that to really drive, unless rates just go crazy, right? If they go crazy, then obviously that's going to have a bigger impact, but I don't see that happening.
It's the right conclusion, Jeb. It's the wrong metric. Anytime I hear someone talking about ratio of income to housing prices, I say you're being dumb, because part of the reason why homes were so affordable during the pandemic was interest rates were really, really low. So it's income to housing payment. So housing payment brings that interest rate into the equation and tells you where we can go. And really, what do we talk about at that point? We're talking about affordability, income, house price, interest rate. So with affordability is the brake that keeps home prices from accelerating at this point.
So what I hear you say is you only want to work with smart veterans, and you just called Orange Pulp dead.
No. I'm saying
Josh. That's what I heard.
I'm saying he probably read that somewhere, and it was someone writing an article saying, hey, there's going to be a crash coming because no one can pay more because home prices as a ratio of income.
If you want a picture of Josh's face, I will print one out and send it to you, just in case you want to throw darts at it, do something fun. I have a bunch of photos. I'm willing to send them. I'll even blow it up for you, and you can use it. I just need video so that I can use it on here. No, in all reality, Josh is accurate. Yeah, it's it comes down to payment. Has less to do with anything else. All right. SK says he hates all the guys who are saying housing crash, housing crash. I agree. I agree with that. I've said that for 3 years now. And I was the outlier, and I'm still the outlier, it looks like. But we'll see. Those people that were on here 3 years ago, there's a few of them that still show up, but most of them that said, just wait 6 months, just wait till next year this time. I hope this video never comes down. I'm still here, dude. I don't see your comments anymore.
No, it's just wild, Jeb, because literally they were saying it from day one of the pandemic. There were channels out there saying it pre-pandemic, but from day one, literally we're up 45%. You would need a 25% correction to even be close to right. You still would have missed out on 25% of the appreciation on the way up by making that call and just continuing to make it, hoping that eventually you would be right.
Well, Josh, that brings me to, hold on here, another chart that you sent me earlier that I'm going to put up here on the screen because I think it's a great chart to have a conversation about. And it's this one. Change in U.S. rent versus income growth since 1999. So if you look at that,
that's a wild chart.
Guess what doesn't change over that period of time? A fixed rate mortgage. Oh boy. But
Jeb,
134% increase in rent since then.
So we had the last 3 episodes of the podcast that we've done have really been polarizing, apparently, because lots of haters coming out with aggressive, crazy hot takes. Several of them saying, how do you expect me to save? The people telling me to save are the same ones that keep raising my rent, so I can't save. Like, if I boil down the arguments here, what people were saying is, okay, you shouldn't buy because the market's going to crash. And we said, okay, if you're not going to buy, here's how you save. Well, I can't save because rents are too high. So you really have this third camp that says, I'm not going to buy. I'm not going to save and invest. I'm just screwed. This whole fatalistic approach. And I'm not saying that there aren't people out there. My belief is that most people don't give themselves credit. We've talked about this on the show. Go to your boss, ask for more responsibility, ask for a raise, go put your resume out there. Look at moving to other parts of the country. I think home ownership is really important, more important than where you locate yourself. I'm not saying everyone should look at it that way, but like, I would just never put myself in that third camp of saying, I can't afford and the world has conspired against me and I can't save. So I'm going to sit over here and hold on for dear life. That's like a very fatalistic approach. And I don't think most of you that show up here every week feel that way. We'll get an interloper in here in the comments throwing their little peanut gallery comments.
Yeah, we only have a couple minutes. Well, I got 15, but comment. So this, in the podcast last week that we talked about, we actually addressed this. It says you're not factoring in massive tax increases, insurances, and cost of repairs. You're just talking about a fixed house payment. So let me, explain this. Tax increases. My taxes, I bought my house 10 years ago, have gone up minimal at best here in California.
So
I realize other states are different.
Assume you're not in California though, Jeb. If you look, I look at taxes in other states and the value of the home, do they go up? Yeah, most states have large homestead exemptions, so you're not getting hit with that. Other states besides California have Prop 13-ish limitations on that. So it's like, if you want to throw it out there and say, like, listen, you can throw that up there. You can tell me maintenance. You have to handle cost of repairs. Say, okay, then explain to me how homeowners have 44 times greater net worth than renters and 65% of it is in home equity. People have these arguments, but we have 100 years of experience that people come out ahead when they own their home. I'm not saying it's easy. I'm not saying you don't have to account for those things, but that's not a but I'm better off.
I wanted to go down this rabbit hole just a bit. Insurances. My insurance over the last 10 years has increased very little. Cost of repair. So this one is really interesting. In the time I've been there, I'm trying to think in my head, what actual repairs have I had to do that were 100% had to be done? My water heater went out once, so I had to replace that. And at the time, it was only like $1,200 to replace it. It's like $2,500 now. So it's gone up considerably. But every other thing I've done in my house has been a want to do, not a need to do, a want to do. So I could have chosen not to do those things, but I did upgrade it. I did do those things. And guess what? I'm going to get the money back in those upgrades, cosmetic wise, because the property is in today. It's what buyers want. Maybe not dollar for dollar, but it wasn't money wasted. And plus, it's what I wanted. I wanted to live in it like that. I didn't want to live in it the other way. I wanted to make changes that made me happy to go home and see my house. So there is an argument for it. And I'm not sitting here, casting stones saying that none of those things are factors. Sure, there are things that you should consider. But like Josh said, the data supports homeowners. Bottom line. And I would imagine anybody here sitting through an hour of this wants to become a homeowner. Otherwise, it's the definition of insanity, right? I mean, just sitting here doing the same thing over, expecting a different result. The result isn't, is a byproduct of you buying when it's the right time in your life and taking all the things into consideration and appreciation, inflation, all of those things over time. Home prices going up in value.
Jeb,
It's that simple.
I'm going to see if I can find it while you're talking and answering the next question. The chart that we'll go to, the one that will absolutely blow your mind, forget the other stuff that I was talking about. The average house payment in the United States relative to the average rent. So we're sitting here saying, no, taxes, insurance, all this stuff is going to go up. The average house payment is about half of what the average rent is. That doesn't mean that the person going out and buying a home is going to pay half of what they're going to pay in rent. They're going to pay more than what they pay in rent in nearly every market in the United States right now. But in 15 years, 20 years, 30 years, they're going to pay about half to a third of what rents are for those that have mortgages. Most of these people, if you look, what do we say, Jeb, the number's 35% of homes in America are owned free and clear.
42%. It was on the latest podcast with Logan Matashami. 42% of homes in the US are owned free and clear.
So you just sit here and say, what are we talking about? Like, if you say, hey, homeownership is not a reality, I can never make it happen. Cool. Deal with it, go along with it. But to sit here and try and argue to other people why that's a viable path or going to put you in a better place in the long run, it's not. And I'm not sitting here. We talk every week. Homeownership, becoming a homeowner is hard right now. It was relatively easy 2.5, 3 years ago, as long as you could fight the bidding wars. It is not easy, but the alternative is worse. So I don't know, for what it's worth. Like, I don't want you guys sitting here saying, hey, everyone's dumb, you should go out and buy a house right now. I know it's hard. I know it's not possible for a lot of people, but that should be your goal and aspiration. And you should be willing to sacrifice a lot to make it happen when the time is right for you in your life.
All right, good stuff. Just going to answer, you're going to look for a chart, I guess, Josh. Yeah. Why is anyone sitting on cash? Must be sellers, but then who bought their house? I would think anyone that has cash in 2020 would have been buying. Not necessarily. I'll tell you, I had clients that sold in 2019, a specific couple I can think of that sold because home prices were high and they thought that they needed to correct in order for them to get their next house. They don't own a house today. And there's several stories like that. And I'm not laughing at that idea, but it's a conversation that we have when somebody's thinking that idea. It's okay. Why are you thinking that? And walking it through a lot like we do on the show. And all you can do is lead a horse to water, right? And so they're still not homeowners today. So are there people sitting on cash? Sure. I think a lot of it is some people have saved, some people have sold properties sitting on them. You also have to remember money was really, really cheap over the last couple of years. So some people have taken equity lines, done different things and have excess cash flow. Plus businesses have done very, very well over the last couple of years, even with the craziness in the pandemic and the lockdown. And people had savings, right? They couldn't go anywhere for the better part of 3 or 4 months. So a lot of people put money away, didn't spend money, didn't go out to dinner, didn't do all of these things for an extended period of time, didn't go on vacations, didn't do anything. And so with that, there's a lot of cash out there. But I'll be honest, I'm surprised every single time there's a cash offer on $1 million, $2 million, $3 million property, because it's almost like clockwork. Every single time there's a cash offer and you're like, who has all the cash? And I'm again, dumbfounded every time, but it continues to happen. And, we continue to talk about it. So with that said,
on the VA live show, Jeb, we were talking last night about assumptions and we're like, okay, who has the money on VA to come in with the big down payments? And Carmen, the realtor on the show, has done 6 of them this year, 6 assumptions. She said nearly everyone is a veteran PCSing, which is the military moves you from one duty station to the next. They sold a house, they had a bunch of appreciation, and they came and they bought from a veteran selling for whatever reason, whether they were getting PCS'd out, and just moved their equity over and assumed this super low interest rate. So win-win in both situations, but a lot of people sitting on a lot of appreciation. So Jeb, I haven't found the chart, but I have the data here. It is from Census data. 2021. So that same chart that you were looking at, the average. So we talk about the difference between the average and median. The average monthly mortgage payment in 2021 is $1,427. The median is $1,000. So add your taxes and insurance on top of that, and it is way less than what renters are paying. And eventually, absent cash out refinances or just rate and term refinances where you keep pushing the payoff 30 years out into the future, you're going to eliminate that payment entirely and just have your taxes and insurance.
There you go. Kyle says, State Farm announced today that they're pulling out of homeowners insurance in California. It will go up. Here's the deal. State Farm was the most overpriced insurance company out of all of them to start with. Just saying. So bye. I mean, I didn't go with State Farm because it, with $300 to $400 more a year than Mercury or one of the other ones. And I've had claims and I've done, had insurance and they've all been paid. So maybe I end up the idiot at the end of this thing. But if State Farm leaves, that means, the insurance companies out there will have more premiums coming in to them. I don't know that necessarily means higher premiums for everyone else, but it's the fire areas. It's the areas that have potential natural disasters that, essentially these companies are trying to get away from. And so the easy answer is we're not doing any of it because we don't want to insure here and there. And it is what it is. So it doesn't affect me, at least at the moment.
Jeb, this is a good question here. Going back to your folks that just bought in Orange. For Jeb's clients that bought the $900,000 fixer, do they take out a larger mortgage or spend the extra on improvements? How does that work?
Yeah, so they were originally putting down about 15% at a million. So say, for example, they were buying $1,170,000, $1,180,000. They were usually financing $1 million mortgage. So they're putting 170 to 180 down in that scenario. So that works out to 15-ish% down. The house that they bought, they ended up at they purchased it for $950,000. They ended up paying $1,050,000. So they paid $100,000 more for the house. And they financed, they put 100,000. What did they do? They put 10% down. So they put $105,000 down and financed the rest, because they wanted to do improvements. It's a large lot. It's got a lot of potential, a lot of opportunity, but fortunately he's a contractor, by trade and plans to do a lot of the work himself. And so it was the right call for them. All right, Josh, we got 4 minutes. So
it's a good one. It's a good one here, Jeb.
Yep.
And it's fairly easy. Best method to smoothly inherit a property and avoid capital gains or any other tax headaches. You want to explain why that's short, quick, and easy answer. Yeah. But why are there no capital? Why should there be no capital gains on an inherited property?
Because when there's a step-up basis when it's inherited through a trust. And so what happens when a property is in a trust, it gets passed along to heirs. You get something, I forget exactly what the verbiage is, Josh, but you essentially get the step-up basis of that property. So say, for example,
and it doesn't have to be in a trust. You can inherit it. It can go through probate, however
correct.
You get it when you inherit the property.
But in the tax headache part is why I said trust, because by probate, you're going to get hit with fees and time and issues and headaches, more importantly, versus it being in a trust. You can avoid all of that. But that's really it. I mean, without getting into deep detail, having your property in a trust, honestly, anybody that owns a piece of real estate should have it in a trust to some extent. It doesn't have to be this crazy trust. You just need to have direction as to where that property goes, how it's passed along. If you can do a trust, that's better. But I would highly, highly, highly recommend doing it for everybody else's sake. If just take yourself out of the situation, your kids, your family, everybody else will have a smoother transition because you taking the time to do that now. They're obviously going to be sad if you pass, but they're dealing with that. And then they have to deal with the headaches of all of this other stuff. It's an emotional roller coaster. I see it all the time, and it can be avoided. So
side note on that, Jeb, that stepped up basis is huge. And it literally means that the greatest financial legacy you can leave to your family is appreciated real estate. I'll give you the example. My dad paid $127,000 for his condo in 1987. When he passed in 2020, it was appraised. So we do an appraisal. So we know what our basis is in that property, $463,000. So if he had sold the house, he would have had $300,000 of taxable gains. He has the $250,000 exclusion. He would have paid capital gains on the $50,000. My sister and I get it at the stepped up basis. Now, if we sell it for $500,000, $520,000, we only pay taxes on the gains from there. So if you have heavily appreciated real estate, the best thing you can do is leave that for your children. Even if they choose to sell it, they are going to have those gains that you enjoyed during your life tax-free.
There you go. So hopefully that is helpful. I mean, that's probably the best part of the show right there. That was the number. If you take anything from this show, take the last minute and a half, because honestly, it could save you so much time, effort, and energy, and it will be the biggest benefit to your family long-term, and really getting toward that generational wealth that we talk about all the time. So guys, it is that time. Went by quick, and I would consider going over a little bit, but unfortunately it's middle school orientation night. I have a middle schooler next year. Holy shit. How that happened, I have no idea, but he's going into middle school, and therefore I have to go and, I guess, see what he's going to be learning. I'm not sure. But with that said, guys, we appreciate you being here. Josh, any parting words this evening?
I'm just looking at the unanswered questions. We're going to have to do like a 5-hour show at some point in the future to catch up on all of these, Jeb.
Josh, maybe if there's time over the next day or two, we could pop on here and answer some of these questions. I don't know. Maybe we'll do it on the other channel, on the Educated Homebuyer channel. We'll see what happens. But let's remember those questions. Let's dive into it, guys.
So the only way for you to know is to subscribe to that channel to get notified in case we go live and fire through all these questions.
There you go. If you haven't done so already, like, subscribe, check out the Educated Homebuyer podcast. Reach out to me if I can be of assistance to you. If you need Josh, a lender anywhere in the country, real estate agent anywhere outside of Orange County, that link at the bottom will get you there. Right, guys. Until next time, adios.